The Australian dollar is one of the five most frequently traded currencies in the market. Australia owes its popularity amongst currencies traded to what is called the three Gs: geology, geography, and government policy. Geology has given the company a wealth of natural resources that are in high demand, including oil, gold, agricultural products, diamond, iron ore, uranium, nickel, and coal. Geography has positioned the company as a choice trading partner for many fast-growing Asian economies that nearly insatiable resources demand. Government policy has led to fairly stable high interest rates, stable government and economy, and a lack of intervention in the currency market. How foreign exchange works. While we need foreign currencies that will be travel overseas and companies that may require to do business with suppliers in other countries, and other major influences on exchange rate movements as institutions and investors try to benefit from ups and downs. For example, if an investor thinks that the AUD is going to fall relative to the USD, they could use Australian dollars to buy US dollars through an online trading platform. They would then aim to sell these US dollars once the anticipated movement occurred, so they ended up with more Aussie dollars than started with. Currencies traded buy in and out of these exchange rate pairs all day long. Of course, exchange rates don't always move as investors expect, so they can make losses as well as gains on the way. Today we'll compare the influences on the AUD over USD and GBP over AUD. The level of demand for a currency will affect its market price. If there are more people wanting to buy AUD over USD, then sell it. The AUD's value will go up. More sellers of the AUD over USD means that the value of the AUD will go down. The same concept applies to GBP over AUD. So what influences whether people want to buy it or not? Some key reasons that can impact the currency of AUD over USD and GBP over AUD include the outlook for global growth, how inflation affects the currency of the pair, and the gap between interest rates in the two pairs. Global growth. Whenever global growth forecasts have been revised down, AUD over USD tends to come under downward pressure, which means Australian dollar loses value relative to the US dollar. Generally, when we see a period of increasing volatility in the market, we also tend to see the Aussie dollar falls. The US dollar in the world's reserve currency and US government bonds are considered a relatively safe investment. So when financial markets sense an increased level of risk, the demand for these safe haven assets tend to increase. As for GBP over AUD, there have been some fairly significant movements for the pound sterling GBP exchange rates, especially against the Australian dollar, showing a rise back out of contraction to growth from 47.4 to 52.9. The burst of optimism generated by this news was deflated later in the week when the National Institute of Economics and Social Research (GDP) estimates for Q3 show a downwards revision. The NIESR additionally stated that there was a distinct risk of a UK recession in 2017. While the Chancellor also alarmed investors by announcing the date of the autumn statement, November 23rd. Interest rate changes. Australia is also known amongst the currency traders as its Reserve Bank is to be highly conservative, whereby inflation is always controlled and therefore interest rates are always high. Interest rates have historically been much higher in Australia than the US for a long time now, while the momentum is said to be shifting. So the appeal of buying Australian dollars to the benefit from the interest you can earn of some of them relative to other currencies been worn off somewhat, and money has been moving back into the US in anticipation of higher rates there. The economy of Australia has a fairly bullish cycle of events working in its favour, when there are just some of the reasons that traders flock to the Aussie dollar. Because of these high interest rates, differential between Australia and the United States, the Aussie dollar remains a favourite of the trading seeking volatility. During bullish market environments, the AUD over USD can run up faster than many pairs due to its interest rate differential. During bearing market environments, AUD over USD can fall much faster than many pairs due to its interest rates differential. How interest rates have affected AUD over USD in the last year? Well, the Federal Reserve delaying of interest rates hike to late 2016 has cushioned some of the fall in the Australian dollar to US exchange rates. The performance of the underlying economy measured by job creation and unemployment has also been held up relatively well given the level of the price decline in the export key commodities. The sentiment surrounding the upcoming US interest rate decision has changed dramatically in recent weeks, and with this coming at the same time as sudden hints about a further interest rate cut in the UK, the value of the pound and therefore buying Australian dollar rates are moving and sliding much more heavily than normal. Whilst not providing a direct impact on views of the Australian and UK economies, the US interest rate decision is a massive event and causing extensive ripples to present through the financial world, with currencies seeing the largest effects. The anticipated and uncertainty surrounding the US vote is set to exaggerate this. The US raised their rates last December from 0.5%, and after months of waiting, pressure is mounting on the FED to raise rates further to 0.75%. Should this happen, the pound will look even less desirable by comparison to the likes of the US dollar, an event of the Australian dollar, which still enjoys the 1.5% interest rate on these holding the currencies. How interest rates have affected GBP over AUD in the last year. There are two reasons why it is predicted that there will be further falls in GBP over AUD in the next 6 months. First being that the RBA has been adopting a more bullish attitude. There is a probability of more interest rate cuts. Second, the Bank of England is also likely to cut rates once again since becoming unstable after the referendum. Aside from the UK's and Australia's own monetary policy plans, the GBP over the AUD exchange rates direction is currently also being influenced by the US Fed Reserve Bank monetary policy plans. It is likely that when interest rates are increased in the US, that the pound will gain on the Aussies as the moment that the Australian dollar has been benefiting as many investors worldwide wish to hold funds in AUD due to the high interest rates offered by the Aussie banks. Once rates increase in the US, we're expecting the pound to gain value on the AUD as deposits will likely switch from AUD to US dollar, which will weaken nicely. Inflation. Once important determinants of a currency's trading weight exchange rates over a long run is whether it has a higher or lower inflation rate than its trading partners. The theory of purchasing power parity suggests that the exchange rate between two countries will adjust to ensure that the purchasing power is equalized in both currencies. If a country's inflation rate is persistently higher than its trading partners, its trading weight exchange rate will tend to depreciate in prevent a progressive loss of competitiveness over time. Let's assume that the graphs above is a representation of the currency of Australian dollar. In the graph, if D2 increases to D1, which will demonstrate an increase in the quantity of the Australian dollar currency and inflate the price of the currency, hence the example if the inflated rate of the Australian dollar was higher compared to the rate of, let's say, the GBP, where the GBP currency would remain steady, hence appearing to look relatively cheaper compared to the Australian dollar. As a result, this would lead to an increase in demand of the GBP currency. If the supply of the money increases, then quantity of the AUD dollar will increase and inflation will decrease. If the interest rate for the AUD dollar increases, then foreign investors would want to start saving their money in AUD dollars, hence would demand the supply of the Australian dollar to invest in AUD currency. Hence, there would be an increase in the supply of the AUD dollar, including an increase in supply of the GBP, as foreign investors would need financing to invest in the Australian dollar. Predictions on the Australian dollar over the US dollar. The RBA has already lowered rates twice this year, and if the inflation falters or the exchange rate jumps, the bank will certainly consider another quarter rate cut. It's the opposite story in the US, with a rate hike still a reasonable possibility in December. Predictions on the GBP over the AUD. There are some positive news for the UK, with the second successive month of improving inflation expectations after almost 15 months of consecutively concerning news. This is attributed to the benefits of the holiday season, a cheaper pound, and a slight rise in oil prices. As they say, only certainty in markets is uncertainty. However, based posts on the election of the US interest rates are predicted to increase, and is therefore expected that the more AUD dollar will be sold, more investments will be made in the USD dollar. As for GBP over AUD, it is observed that the fall in the GBP over AUD is likely to continue, with the predictions that there will be not much more movement. Thank you.